Hello everyone, welcome to the Pileinvesting channel. We bring insight story of the best investment techniques and research by expert gurus. We are going to discuss the best-selling book called One Up on Wall Street, written by Peter Lynch. It is a very useful book for beginners who want to gain some basic knowledge and concepts about how stocks work in the financial market and how to select the best company stocks. After Warren Buffett, Peter Lynch is one of the most successful and well-known investors of all time. Lynch is the legendary former manager of the Magellan Fund at the major investment brokerage, Fidelity. He took over the fund in 1977 at age 33 and ran it for 13 years. His success allowed him to retire in 1990 at age 46. He wrote a few best books to help normal investors. We bring insight key takeaways of his books. One Up on Wall Street is divided into 6 takeaways. Let's dive into it. Takeaway 1. Curiosity to learn. Peter's family viewed stocks as forbidden fruit when he was a child, especially in the wake of the Great Depression. However, young Peter began to hear rumors of stock market wizardry from powerful players, spurred on by his curiosity and his job as a golf caddy. Joining Fidelity, Peter soaked up stock wisdom like a sponge, ignoring the academics' theories that clashed with his real-world success. He expanded his portfolio, sometimes owning hundreds of stocks, earning him the title of the Will Rogers of equities, never meeting a stock he did not like. Through ups and downs, Peter showed that anyone can master the stock market with curiosity, guts, and a pinch of luck, disproving the myth of a born-to-invest elite. His journey from curious kid to stock market maestro is a testament to the power of learning, experience, and a touch of unconventional thinking. Big funds face challenges because they must follow more rules and cannot easily invest in smaller, fast-growing companies that could offer big returns. They do not have to follow strict rules like professionals do. They can take advantage of opportunities that professionals might overlook. Takeaway 2. Important to stay in the market. Peter Lynch talks about how people often ask about the state of the stock market after his speeches, wondering if it's a good time to invest or not. He humorously mentions that every time he gets promoted, the market tends to go down, showing that predicting the market is quite tricky. He emphasizes the importance of focusing on great companies rather than trying to time the market, citing examples of successful long-term investments. Overall, Peter's message is to approach stock investing with a focus on solid companies, a long-term perspective, and a healthy skepticism about trying to predict short-term market movements or economic trends. Peter emphasizes the importance of observing everyday life and work environments for investment opportunities. He suggests that potential investment ideas are often found in common experiences and interactions, rather than being limited to Wall Street insights. The idea of a 10-bagger refers to an investment that increases in value tenfold, highlighting the potential for significant returns if one can identify such opportunities early. He also discusses the importance of having an edge in investing. He stresses the value of investing in what you understand and have insights into, rather than following trends or tips from others. The author shares personal experiences of missed investment opportunities despite being well-placed to recognize them, underscoring the need for investors to act on their insights and knowledge. Bonds offer interest payments, and historically, they have provided steady returns. For example, if Native Americans had invested $24 in bonds in 1626 at 8% interest, it could have grown significantly over time. Bonds can be more predictable than stocks because they pay interest regularly. Despite these risks, bonds have been attractive in the past 20 years due to fluctuating interest rates. Stocks, on the other hand, historically offer higher returns than bonds. Over time, stocks have outperformed bonds and other investments. Both stocks and bonds have their pros and cons. Bonds provide stability and regular income, while stocks offer higher potential returns but come with more risk. Ultimately, the capacity to withstand market swings, have common sense, and be patient are all critical personal traits for success in the stock market. Takeaway 3. Do not follow the crowd. Peter Lynch emphasizes the importance of thorough research before making investment decisions, highlighting that just because a stock catches your attention does not mean it's a buy signal. He stresses the significance of developing the story behind a stock, which involves understanding the company's fundamentals, market position, growth potential, and other relevant factors. Peter cites examples like Taco Bell in fast food, Walmart in general retail, and The Gap in clothing retail, all of which succeeded initially in one area and then replicated their success in other markets. The author further discusses the concept of cyclicals, which are companies whose sales and profits fluctuate regularly, often in a predictable manner. They highlight cases like Pebble Beach and Newhall Land and Farming, where the underlying assets far exceeded the market's valuation of the companies. Understanding a company's basic business is crucial for investment decisions. The author discusses the importance of investing in companies with a niche market or exclusive franchises. Avoid the hype. Do not rush to invest in the latest hot stocks just because everyone is talking about them. Do not follow the crowd. Just because something is popular does not mean it's a good investment. Do your homework. Research the companies you are interested in. Stick to investments with a proven track record. Imagine you are exploring investments in companies like Sensormatic, known for their anti-shoplifting systems, or others in your portfolio. Are you a slow grower like a utility worker, or a stalwart like a corporate manager? Maybe you are a cyclic worker, earning in bursts like a seasonal business. Investing is like betting on a company's future earnings. Keep an eye on trends and company plans to boost earnings and avoid overly optimistic valuations, much like you would in your own financial life. A small request before we proceed. Please remember to like the video and subscribe to Pileinvesting. Your support helps us create more helpful content for you. Takeaway 4. Focus on big pictures with no rush. Imagine you are choosing a stock to invest in. First, figure out what type it is, like a slow grower or a fast riser. After that, dive into its story. What's the company doing to grow or bounce back? Analyst reports and value line essays can help, but if you have got insider info, that's gold. Think about why you are interested in the stock and what could make it succeed or stumble. For example, if it's a slow grower, maybe you are into it for the dividends. If it's a turnaround, see if the company's new plans are paying off. Or if it's a fast grower, figure out where and how it's keeping up the pace. Being able to explain why you like a stock in 2 minutes flat means you get it. And remember, sometimes even the best ideas can flop if they are not proven yet, so do not rush in without doing your homework. Annual reports can be dense, but focusing on key financial indicators can give you a quick snapshot of a company's health. If you are unsure, resources like ValueLine can break down complex financial data into simpler terms. Peter Lynch emphasizes the importance of focusing on the long-term growth potential of investments rather than trying to time the market. Additionally, he emphasizes the need for investors to do their research and not rely solely on tips or recommendations from others. Also discusses the benefit of investing in companies indirectly through their foreign owners, citing examples like buying Seagram to gain exposure to DuPont, or purchasing European stocks for Magellan to access Food Lion's valuable European operations. Furthermore, he touches on cash flow as a crucial metric for evaluating investments, emphasizing free cash flow as a key indicator of a company's financial health and potential for growth. Peter discusses pension plans and their impact on company valuations, noting the importance of evaluating pension fund assets and liabilities. The author stresses the importance of analyzing pre-tax profit margins to assess a company's efficiency and resilience in varying economic conditions. The author provides a thorough analysis of the growth company life cycle and emphasizes the need to regularly review the company's success. The author emphasizes how a company's story is always changing and how important it is to keep abreast of important measures like earnings, market reach, and growth initiatives. Takeaway 5. Investing key terms and highlights. Let's have a short explanation of investing key terms for understanding. Stocks in general. Monitor insider buying and company share buybacks. Assess earnings growth consistency and the company's financial strength. Consider the balance sheet strength, cash position, and net cash per share. Slow growers. Focus on dividend history and regular increases. Analyze the percentage of earnings paid out as dividends for risk assessment. Stalwarts. Evaluate the P/E ratio of the company's long-term growth. Check for any diversifications and assess long-term growth rates. Cyclicals. Monitor inventory levels and supply-demand dynamics. Expect a declining P/E multiple as the business cycle progresses. Understand industry cycles and anticipate upturns and downturns. Fast growers. Assess the significance of the company's main product to its business. Look for consistent earnings growth rates, preferably in the 20 to 25% range. Ensure the company has room for further expansion and a reasonable P/E ratio. Turnarounds. Evaluate the company's ability to survive creditor raids, debt levels, and cash position. Understand the turnaround strategy and any divestitures or cost-cutting measures. Monitor business recovery indicators such as cost-cutting and increasing sales. Long-term strategy. The focus is on sticking to a long-term strategy despite short-term fluctuations. This includes understanding that not every year will yield high returns, and there will be periods of low or negative returns. Historic market average. The historic market average return for stocks is mentioned as around 9 to 10% annually. This serves as a benchmark against which individual performance can be measured. Diversification. Diversifying investments across different categories of stocks is highlighted to manage risk. Each category has its risk-reward profile. Portfolio management. The passage suggests owning a manageable number of stocks, perhaps between 3 and 10, to balance risk and potential returns. It also discusses the strategy of rotating stocks based on their performance relative to their underlying fundamentals. Now you are familiar with investing terms. Peter Lynch discusses the best approach to buying and selling stocks, highlighting that the best time to buy stocks is when one has found solid merchandise at a good price, emphasizing individual conviction over market timing. Investment gimmicks have become so popular that the old motto, "Buy a share in America," ought to be changed to "Buy an option in America." Invest in the future of America now means take a flyer at the New York Futures Exchange. Peter shares a critical view of these strategies, pointing out that they distract from the core principles of investing in solid stocks. He highlights the high failure rates among amateur players in futures and options, noting that they are riskier than traditional investing avenues like stocks. Peter aligns with Warren Buffett's view that stock futures and options should be outlawed, emphasizing the zero-sum nature of these instruments compared to the wealth-creating potential of investing directly in companies. Takeaway 6, Best Long-Term Stock Strategy. Peter Lynch reflects on their tenure as a stock picker, recalling various major news events and their impact on stock prices throughout the decades. The author highlights pivotal moments such as the Cuban Missile Crisis, President Kennedy's intervention in business, and Nixon's actions, showcasing how unexpected events can sometimes have more significant effects than major geopolitical crises. They also delve into the market's reactions to price controls, resignations, and technological advancements, offering insights into how the market can behave contrary to expectations. Throughout the narrative, the author emphasizes the importance of understanding market trends and staying focused on long-term investments. They discuss shifts in trading hours, the rise of institutional investors, and the impact of technological advancements on market dynamics. The author's experiences lead them to advocate for patience, a long-term perspective, and a focus on quality investments rather than short-term gains. Ultimately, the author's perspective underscores the complexity of the stock market, where historical events, economic trends, and human psychology intersect to create a dynamic and sometimes unpredictable environment for investors. That wraps up the world's best personal finance book lessons. I hope it will help to make your financial decisions better, and ideas will help improve your life. Be sure to subscribe to our channel Pileinvesting for more learning and growth opportunities. Until next time, goodbye.